Hi friends, let's learn a new lesson in behavioral investing. Nowadays, everyone wants to go in for pre-wedding shoot or wants a new mobile phone as and when a new model comes. Wants to invest or trade in stock, securities, or very recently crypto, or wants to buy a new car, or wants to wear the clothing of the latest fashion. So what is common in all these examples that I am citing? The most common thing is that the decision to follow others, follow what is going on in society, what other people are doing. So our decisions are impacted very often by what other people do, what our friends are doing, what neighbors do, what our peer group is doing, or what is going on in society. And it is not necessary that every decision that we take, as far as following others is concerned, is always in our interest. Not necessary. It could even be detrimental to our interest. It could be harming us in the medium to long term, but still we are somehow affected by this behavior which is called herd mentality. So herd behavior, herd mentality is what impacts us negatively. In 2012, I read a wonderful book written by late Parag Parikh. He was a very noted investor and founder of the Parag Parikh Mutual Fund. So the title of that book is Value Investing and Behavioral Finance. In that book, he came up with the data where he analyzed the performance of the 15 most neglected sectors of the Nifty 50. He did one back testing of the data where if someone had invested a certain sum on 1st of Jan every year continuously for say 10, 12 or 15 years in the most neglected stocks of Nifty only, the end result after say 15 years, it was like the portfolio of those stocks or that investing methodology produced more or less the same return or even slightly higher return than the Nifty with significant lower downside volatility. That means you got the same return as Nifty but with significant downside volatility. So this is called contra investing. A contrarian investor generally goes against the crowd. He picks up the stocks which are ignored mostly by the market. See, what happens is that in market at different points of time, different sectors become darling of the market. Market, as and when a sector becomes darling of the market, all the money starts moving towards that particular sector, resulting into sudden valuation spurt, sudden price spurt in the prices of that sector or the stock. So those who are left behind think that they suffer from a fear called fear of missing out. So they also participate towards the fang end of the movement. And ultimately what happens is that mostly they lose the money. That is, they are not taking decision independently and analyzing the options rationally. Instead, they are impacted by what others are doing. So similarly, you will find that often there is euphoria, there is fear, greed. So all these are the factors which impact our decision making as investor and trader. Therefore, we should always try to escape this herd mentality and try to be rational in our decision making, not only in the field of investing but even in our life. I hope the concept of herd mentality is now clear to you. If you liked this video, kindly do subscribe to my channel and help me promote financial education amongst the masses. Thanks a lot.